Really enjoyable first presentation, and now we're going to go on to our second one with Christina and Peter, and Dr. Faruqi will be moderating this discussion today. And
yeah, so it's really great to be here today. The issue we want to talk to you about is the sustainability interaction between the global production system and the global financial system. And those two paired together are really kind of the core tenets of the modern economy. And we kind of want to use the 2007 recession, which is ongoing today, as our medium for investigation and analysis. So yeah, my name is Peter Dargie. I'm in my third year of the Honors Math program.
Yeah, and I'm Christina. I'm also in my third year studying math and philosophy. So this project is really interesting for us because it's not really related to our fields of study, but it's still in our areas of interest. So thanks to Atlas for allowing us to really dive into something that is a pertinent topic today. So really what inspired our project was the current events surrounding the global financial crisis, as well as several books that we read which talk about this interplay we're going to be talking about, globalization and financial markets in general. So this is a quote from Niall Ferguson in The Ascent of Money, and he says, "Bread, cash, dough, lucre, muller, breadies, the wherewithal, call it what you like, money matters." And I think this just really speaks the truth about, what is our society founded on? What are the markets founded on? And how does the world run? It's all based on money. It's just an important facet of society. So the first thing we're going to talk about is to try and give some context and background to this issue. So the global production system really started when human interaction first started. And this is a quote from John Chapman describing these early interactions of trade. And he says, "Trade in markets may be said to have started when people previously self-sufficient in some rudimentary fashion began to specialize in the various tasks and exchange them with others. This exchange made everyone participating better off." So what he's describing here is really the beginnings of the global production system. And this was just a really primitive economy structured around the physical production of goods and services, and no currency was exchanged. But with the inception of a state-issued currency, this provided a new medium of exchange and allowed for the accumulation of wealth.
Yeah, so basically why we want to talk about the history of this development is it's a dynamic which has changed over time. Basically what we've seen is, the global production system began kind of at the dawn of human development. And the GFS really came into play in the 12th century. We're going to talk about that. But the dynamic between the two has changed over time. And now the GFS is kind of this overarching monolithic structure which affects every facet of daily life. So now I guess back to the history. So the global adoption of legal currency and international trade, this gave rise to the need for foreign exchange markets. Obviously, if you have commerce in different countries and you have interaction between those two, foreign exchange markets arise. You need to facilitate that, and also growth in capital markets. And so the GFS in that way was an inseparable aspect of the globalizing economy. In 2006, it's worth noting that the interrelationship between the GFS and the GPS had boosted the economic output of the world to around 47 trillion, and the market capitalization of global stock exchanges stood at 51 trillion, I guess. So yeah, the early roots of the GFS are in the 12th and 13th century. And these were when the first banks came into existence and commodity exchanges were formed. And so these commodity exchanges interconnected the existing GPS with this developing GFS. One of kind of the first financial instruments that was developed is called future. We still trade them today, usually for gold and oil. But basically what it allows you to do is a farmer in the 12th century could sell the rights to his crop months in advance before harvest and protect himself from falling prices. And similarly, the buyer could hedge themselves against rising costs. And so it's kind of the basic derivative, and we still trade them today.
So the modern GFS today really started to develop in the 20th century when the global financial system grew at an unprecedented rate. So our paper postulates that there's three main driving forces behind this rapid growth. And the first identifying factor is industrialization. And so with increased industrialization, production efficiency boosted the output of products. And this increased output of products of different supplies corresponded to high consumer purchasing power. And surplus and excess goods were available then for export and trade. And another note for industrialization is that production industries embraced the financial system as an avenue for financing, venture capital, and loans. So,
okay, our kind of second postulated driving force behind the development of the modern GFS is post-materialism. So as people moved away from subsistence and agricultural living and migrated towards city centers seeking higher paying jobs, they want to actualize hopes and dreams, which is, move up Maslow's pyramid. And so to do this, they turn to capital markets for entrepreneurial financing and also for investment savings. So those are two ways, one of innovating and one of growing, which really drove the development of the GFS. So this is a point which is, there's so many points which are kind of critical to the discussion, but saving versus consumption. So with the inception of money and investment banking, private saving, people have this opportunity to choose between saving money or consuming. And it's a critical kind of choice. And if you look at the United States here, if you look at the most recent figure, that is really blurry. The United States was saving 1.2% of household income on average, which is just abominably low. And it's actually one of the kind of root causes of the American economic problem. And so this is a quote from John Chuckman. The importance of savings is that it funds investment in economic capital. Even a relatively small difference in saving rates between two countries can be quite telling over just a few decades. Those who have saved more will have financed a better or greater capital stock, which in turn yields a new level of choice between saving and consumption in the future. And so Asian saving rates are very high. American saving rates are diving and diving. So the modern GFS, our kind of final driving force, we think, would be globalization. So globalization really started when imperial countries, large countries had imperial ambitions, and when transportation became available through industrialization, steamships, rail cars, whatever, this really boosted international trade, and international trade is kind of one of the core roots of the GFS. And yeah, so we don't have much time, let's go on.
All right, so the modern GFS today is now a complex and expansive network of institutions and regulators acting on a transnational basis. And so there's really two sides to the modern GFS. On one side, we have investment banks, hedge funds, and other asset managers, and this represents the private side of the structure. We also have the regulators, and that includes national governments, the IMF, and the World Bank. So in our paper, we really wanted to explore the sustainability of the relationship between the GPS and the GFS, which we've already mentioned earlier. And how we wanted to do this is weighing the risks and the rewards. So what we're going to do is we're going to use past financial crises with an emphasis on the 2007 financial meltdown as a medium for our investigation. So some of the other crises we're going to briefly examine include the 97 Asian financial crisis, the 1980s international debt crisis, the dot-com bubble, and the Great Depression. And finally, to kind of take a look at more comparison, we're going to compare the growth dynamics of economies that are integrated in the global financial system and those who are more isolated, and how the state of their economies.
Okay, so the 2007 recession, so just to give a little bit of quick history, and some of this will hopefully make more sense later. So in 2000s, there were steep increases in commodity spot and real estate prices, as well as a peak in global inflationary rates. And so the economy was running very, very hot. And so if we look at this chart, it plots housing prices on an adjusted basis, and you can see this spike in the early 2000s. In conjunction with a low interest rate policy in the wake of the 2000 dot-com bubble, these events can really be seen as the key precursor for the 2007 recession.
This is just a quote from Federal Reserve Governor Frederick Mishkin at the 2008 Financial Risk Roundtable about the crisis, and he said, "Over the centuries, economies have periodically been subject to asset price bubbles, pronounced increases in asset prices that depart from fundamental values and eventually crash resoundingly."
Yeah, okay, so when the American housing bubble burst in 2007, home foreclosure rates spiked, and the vast majority of these defaults occurred in portfolios of subprime lending, which had been packaged up as CDOs and sold to investment bankers hoping to earn a higher return off the risk. And so this crash was the first in a series of severe blows to the financial system. Okay, so as deterioration continued throughout the financial system, it affected all parts of the globe. This chart was estimated for 2009 GDP growth. And it's fairly accurate to what actually happened. So as liquidity dried up, consumer demand fell, and suppliers of both capital and finished goods saw a slump in profit. Diminished profit margins led to increased unemployment, spiraling the global economy deeper into recession. And so now we're going to go on and look at a few other crises, and what we want to really note is the similarities and that this, the 2007 recession is really an amalgamation of all the issues faced in past financial crises.
So the first one we're going to briefly look at is the 97 Asian financial crisis. And essentially what happened is Thailand decided to let the baht float against the United States dollar. However, Thailand had recently experienced a domestic asset price bubble and was burdened with massive foreign debt in the form of economic investment. As the baht devalued and interest rates jumped, it became impossible for Thailand to cover its foreign debts and pay interest on loan investments. So in many ways we can see that the Thai economy faces similar challenges that the United States faced. The American public debt currently stands at nearly $14 trillion, and this debt is owned principally by Japan, China, and Germany. So a combination of this massive debt, depressed asset prices, and a struggling currency has had massive implications for the global production structure. And as the world's largest economy, the fall of both supply and demand from the United States was highly damaging to the global economy.
Okay, so the 1980s international debt crisis. In the late 1970s, there was a dramatic fall in oil prices, combined with interest rates each reaching 18% per year. And so the result was an inability of debtor states to pay creditors the interest on their debts. In 1982, Mexico could no longer pay its foreign debt. Shortly after, similar announcements were made by several other Latin countries. And this is similar to what we see in Europe right now with Ireland and Greece at risk of defaulting on sovereign debt. And so basically, make a long story short, traders ganged up on these currencies, sold them short using lots of different financial vehicles. And so they were capitalizing on a strong US dollar and unsupported South American currency, which drove these currencies basically to the floor. Debt restructuring negotiations were organized by the IMF, World Bank, and commercial banks. And this provided new loans to these debtor countries and stretched out external debt payments, providing some stability, and this was kind of their resolution. Yeah, so the dot-com bubble, this one's really interesting because the dot-com bubble doesn't really speak about a fundamental flaw in the economy. What it talks about is an equity bubble. And so basically, in 1995, investor speculation about the growth in the recently developing internet sector resulted in soaring stock prices and overvalued shares. So in 2000, the PE ratio of the S&P 500 reached a record multiple of 45. And so, in investing, there's kind of two main modes of thought. There's momentum and value investing. And when either one of these kind of herds of people get scared or has a particular figure which drives them out, the market can get sold off. The PE ratio really simply is if you take, say, a $100 company and it earns $20 that year, then the PE ratio is 5. So if you have a very high ratio, with a very high number, you're stuck with the fact that you have a company which is priced at this much but is earning very little. And so some of these dot-com companies, were trading in, multi-million dollar companies, but producing zero earnings or negative earnings. So the similarity between the dot-com bubble and the 2007-2010 recession is the way in which, not only asset prices, but general equity prices can bubble and invariably burst. When equity prices dive, investors become risk adverse and allocate less money for investment, and this dries up liquidity, which is necessary for economic function.
Masi, you always hear that the 2007 economic meltdown is the worst since the Great Depression of the 1930s. And the notable American economist Irving Fisher famously outlined the 9 principal causes of the Great Depression. And these included distressed liquidation of debt, contraction in the supply of money, a fall in asset prices, a fall in profits, investor pessimism, monetary holding, and a resultant liquidity crisis. And these are all traits that we see during the current global financial crisis. These large-scale financial upheavals are necessarily the result of an interplay between numerous economic failings.
So this chart here, what we have, this shows, I think this is the Dow over the past 100 years. So this is the Great Depression, and up here is the 2007-2010 recession. And that looks negligible in comparison, but this is a logarithmic scale. I don't know what you guys... okay, it's compressed at the top, so just look at the numbers and look at the scaling. But it is on this kind of scale. And in here you can see the 1980s where we struggled. The little dip here would be the Asian financial crisis. Okay, so the sustainability of the relationship between the GFS and GPS. And in our paper, we developed this fully. 20 minutes is a difficult time to give you guys the lay of the land, but we're trying to do it really as quickly as we can. So we want to ask, why has financial history been so inclined to repeat itself in cycles of wild bull markets and bear markets? So ultimately, we must point to a fundamental quality of the GFS, and that's economic investment and then asset repricing. And asset repricing occurs in every recession. It's where basically you have companies or businesses which are overbought, potentially not doing as well as they should be, and they're repriced, revalued lower, go out of business. And this is a core cycle of financial systems. Financial services lie at the foundation of all economic activity. The operation of production, whether for manufactured or products or a produced service, must be financed at every stage. So there's this interconnection that's absolutely necessary for economic function. And this is a really interesting diagram, actually. Over here you have kind of the purest form of the financial system, and over here you have pure production system with demand and supply. Here's regulators, and then this yellow box here is basically holding the core financial system. And so we see a flow from asset management, financial intermediation, so that's investment banking, whatever, corporate finance, so corporate earning power coming from demand and supply, capital demands and financing strategies. So basically you see it's completely tied in, it's fully integrated, it's overarching, and that's a dynamic which was not there originally, and this really developed. And so now the GFS as a single sector is, the GPS is minuscule in comparison.
Yeah, so we can obviously see that the GFS and the GPS are inextricably tied, and especially in an increasingly globalized world, in a system means that weaknesses in one country's financial system can spread quickly to others, influencing all aspects of the GPS and the world economy. So the question we're asking isn't really whether financial markets have a negative impact, because really they're necessary, they're a key function of society, but rather if their increasingly globalized and dominant relationship with the GPS can be economically stable and sustainable. So we've already kind of briefly examined the associated risks involved through the past financial crises. However, it can be argued that these risks are largely outweighed by the benefits of a free, liquid, and more deregulated financial system.
Yeah.
So this is a quote from an author of a book called Global Issues, and he says, "The increased freedom of financial movement has benefited all involved by facilitating trade, enhancing the diversification of assets, and expanding the resources available for development." So we've seen the risks involved with the GFS and GPS, but at the same time, this integration can really help foster the maturation of financial sectors in developing countries. The rise of the capitalist world and long-term success of developing countries such as Thailand, Vietnam, South Korea, and Brazil is a clear indicator of the necessity of an overarching GFS. And we'll see that countries which have chosen to resist becoming members of this global financial community have shown lackluster returns in their economies in comparison to those who are generated under the system.
So Russia is a key example of a nation which has struggled due to its financially isolated economy. And this chart really doesn't do justice, because I suppose when I'm saying Russia, I should be saying Russia and the USSR before. And the USSR growth chart is disgusting. But anyway, looking at Russia right now, and in comparison to China, China is actually a country which is communist in name, but is increasingly opening up its markets to kind of free, privatized operation, and they've opened it up to the global GFS. And so Chinese returns have been fabulous. Russian returns have struggled. This is the recession here, and you can see Russia was hit very, very hard, because when export markets fell, that was basically, that's all Russia has. So the result of China's decision is to really embrace the GFS has benefited not only its own population, but also members of the international community. So yeah, I guess to conclude, we hope that we've kind of made you curious about the topic. We hope that maybe you'll read the paper or go look into it some more, read some of the books. So the integrated GFS provides the opportunity for self-motivated innovators in free economies to access financing in order to increase output. The annualized compounding rate of return of the S&P 500 over the past 100 years is an outstanding 10%. And this includes all recessions, bubbles, and market crashes. So all weighed in there, over 10% per year. This historical trend is sustainable and self-perpetuated as competition for financing has built a stronger economy. In this way, the free market, or the GFS, has allowed for the relatively efficient allocation of capital around the world. And so our conclusion, I guess, would be that there may be instability, but it's not unsustainable. And so, yeah, I hope you guys have questions, and I hope, you look into our paper at some point.
Thank you.
Yeah.
you, Peter and Christina. The floor is open for questions and discussions and comments. And I'm pretty sure Peter and Christina will be more than happy to answer any and all questions that we have as an audience.
Yeah, we had to breeze through things really quickly, so if there's anything you found
Yeah.
confusing, please ask. It's a massively complicated topic anytime you talk about kind of the global financial system, so if there's questions you have. Yes.
We also, we made up some discussion questions.
Just in case.
Just in case, of topics of interest you guys might find interesting.
we think we've